Okay, welcome. My name's Everett Fordner. I'm the Executive Director of Corporate Relations here at the Darden School. Thank you for making it over here from main grounds, those of you who did, and for the Darden students, been in class all day too, thank you. We have a terrific program tonight. My only role is to introduce the person who has been responsible for bringing most of this conference for the next 3 days together. Dan Anglin is a principal at the Prince Henry Group, and is also a graduate of UVA in 19 or something. So welcome, Dan. Dan, if you'll introduce Whitney, that'd be great.
I echo Everett's sentiments. Welcome to everyone. Appreciate all the McIntyre folks coming over. One of the goals for the conference is to give the McIntyre students and the Darden students an opportunity to interact more. Thrilled to see that's happening. An idea is just that, an idea, unless it gets implemented. I want to thank Everett for everything that he and his team, Kristen, Jennifer, all the students from Patrick and Missy right on through have done to make this event a reality. I think we're really privileged tonight to have Whitney here, extraordinarily busy and accomplished hedge fund manager, to take time to give this course. People vote in two ways in life, with their time and with their money. It may say something about my aptitude, but I've taken the full version of this course now 5 times, and you may wonder about, how thick am I that it takes me that long to absorb it. Every time I've taken it, I've gotten something out of it. It's really been extraordinary. There's an old canard, in my opinion, about those who can do, and those who can't teach. In my opinion, that's completely false. Whitney is not only an extraordinary practitioner, he's one of the best teachers I've ever been fortunate enough to have, including in undergraduate school and in graduate business school. So, and giving Whitney 2 hours is completely unfair, but we're going to try to pack in a lot of stuff, or Whitney is, and I really think it's something you enjoy. I hope you'll ask questions. I hope you'll make it a dynamic experience, and without further ado, let's give Whitney Tilson a warm Charlottesville welcome. Thank you.
Thank you, Everett, for your kind hospitality, and Dan for inviting me, and thanks everyone for coming on this evening. Before I get started, I just wanted to explain, I normally don't wear, a very loud electric tie, when I'm speaking in public, but I must say I had a little bit of trepidation, coming from a bastion of liberalism and elitism like New York down here to a red state. But in honor of you all becoming a blue state, I've worn a blue tie, and I'm delighted that you all have joined us in being part of Fake America. With that, we have an ambitious agenda to cover today. Normally I teach this over 8 hours, and we've got 2 hours here. I'm going to go quickly. I'm going to try and leave some time for questions at the end of each section here. And I was talking to Dan, and he said we've got the room, so I've prepared quite a short intro to MBIA, the last case study at the bottom here. And then, I'll try and get through that by 8 p.m. We'll break for just a few minutes, so anyone who wants to leave can do so gracefully. And then I'll teach a much more in-depth case study of MBIA and some of its exposures to CDOs, and doing a very in-depth analysis, drilling into understanding how these structured finance products, RMBSs, in turn creating CDOs and so forth, using MBI as a case study, but I think it will give you a real insight into the absolute madness that took place on Wall Street in even ever creating products like this, and why the losses are likely, have already been and are likely to be even more enormous. So for those of you who are interested in what is will be something I usually teach as part of an advanced seminar on value investing. That will be at the tail end, and anyone who wants to stick around and listen to that is welcome to. So with that, let me start just with a quick overview of what is value investing. And I know it's sort of hard to see, so I'm going to have to play with the computer a little bit as I go through this. But first off, what is value investing? It's attempting to buy a stock or other financial asset for less than it's worth. And this is sort of in contrast to greater fool investing, which is buying something and hoping that somebody else comes along and buys it from you at a greater price at some point down the road. So let me dispel some of the myths about value investing. Traditionally, well, you've got growth investing on one side and value investing on the other side is how most people think about it. But in fact, that distinction is meaningless. Growth is a component of value, but something can be value, i.e. trading at less than what it's worth, and have no growth at all, or even declining growth. Negative growth, shrinking, and by the way, growth is not always good. Some companies destroy value as they grow. The intrinsic value diminishes as the company invests recklessly in growth, for example. So growth is one of many components of calculating what something is worth. But don't confuse growth. That growth and value investing are necessarily different things. And in fact, Charlie Munger has said it best, where all intelligent investing is value investing. So what are the two principles of value investing? If you were to distill value investing down to two things, what would it be? And these are concepts that were first defined by Ben Graham in the guidebook of value investing, The Intelligent Investor. Chapter 8 focuses on intrinsic value. Chapter 20 focuses on margin of safety. And Warren Buffett always gets asked this question on a regular basis. If you wanted to learn about value investing, what would you do? And he always says, go read Chapter 8 and Chapter 20 of The Intelligent Investor. Chapter 8 simply focuses on intrinsic value. What is something really worth? And I've got a slide on valuation a little bit later. But there are two ways to think about intrinsic value very simply. One is what would a rational cash-paying buyer pay to own this entire company or this entire apartment building or whatever it is that you're trying to value? And then a second way of thinking about it is using a discounted cash flow. What a rational buyer would pay for something is usually based on what the future free cash flow that asset will generate over its lifetime, discounted back at an appropriate rate to the present. So I'll come back to that, but there are a number of different ways to calculate intrinsic value. It's more art than science, but that's core principle number one. The second principle that goes along with it is margin of safety, which is simply if you think something is worth between 800 million and 1.2 billion, let's say you can come up with a range of intrinsic value. It's never a precise number because anything involving predicting the future is always there's some degree of uncertainty. So the question, if you think something is worth between 800 million and 1.2 billion, would you pay $1 billion for it? And the answer is of course not. You have no margin of safety. You're paying sort of in the middle of the range of intrinsic value, and that doesn't make any sense because if you're wrong about your predictions about the future, you're going to get killed. What you want to do is if you think something is worth a range, pick the midpoint of that range and then try and buy it for, call it half of that price. So buy a company when it has a market capitalization in the stock market of 500 million when you've calculated that it's worth somewhere between 800 million and 1.2 billion. That way, if you have a margin of safety, if you're wrong, you're likely not to have a permanent loss of capital. So the concept of margin of safety applies in a lot of different things, not just investing. For example, if you were building a bridge and you estimate that trucks going over it might, at its maximum point, weigh 10 tons. Would you build a bridge that would collapse under 11 tons worth of weight? Of course not. You would engineer in a margin of safety such that the bridge would hold 30 tons worth of weight if you anticipated that the maximum amount of weight that would ever be on it might be 10 tons, right? So same concept applies in a lot of different areas. So the most important thing I want to leave you with is value investing does not mean buying crummy businesses because they trade at some low multiple of book value or earnings or something like that. Most successful value investors, in fact, strive for and own very good businesses, but look to buy them when they've fallen out of favor for some reason. So, shifting to evaluating stocks, and I have these 4 questions: the 3 evaluation, and then the 4th price. Posted on the wall next to my computer just to remind me, it sounds sort of simple, but just like a pilot always has a checklist that they go through, even after 40 years of experience, they have a checklist on their knee that they go through before, every time they get in the cockpit, prepare to make a flight. This is sort of my pilot's checklist. Question number 1 is addressing the circle of competence. Do I understand this company and this industry? Can I make some reasonable projections about the future? And the most important thing about Circle of Competence is not necessarily, you should always be striving to learn, look at more companies, look at more industries, expand your circle of competence. The larger the universe of investment situations that you can look at, the more successful you're likely to be over time. But much more important than the size of your circle of competence is how well you know its boundaries and how humble you are and how wise you are in staying within those boundaries. When I look back over my 10-year investment career professionally, the worst investment mistakes I've ever made has almost always been when I sort of got full of myself and thought that I was this expert on some emerging biotech company or something like that, and after I'd lost most of my money, realized that I was the sucker at the poker table. That's circle of competence. Secondly, once I decide that this is something that and by the way, sometimes I'll say I, but there are two of us who run our hedge fund, T2 Partners, so it's really a we. But the second thing we look at is we evaluate the company, but also its industry. So we're asking pretty basic questions. Is it a good business? Does it have sustainable competitive advantages, high returns on capital? Does it have decent growth, healthy balance sheet, strong free cash flows, et cetera? Sometimes we go visit the company, but many times we don't. It depends really on the investment situation and how familiar we are with the company and industry already. And we're asking similar questions about the industry. Is this a good industry? Do we sort of have a tailwind from this industry in that a lot of companies are doing well and profitable, or is it the reverse? And we're trying, if we can, to generate some sort of informational edge. We know people in the industry. We go do store visits if it's a retailing company. We make a lot of phone calls, et cetera, within the industry. Again, sometimes that's part of our investment thesis and an important part of it. Other times not. So then the third thing we look at is management, and we're just asking three questions. Are they good operators? Do they run the business well? Secondly, are they good capital allocators? And keep in mind that most people rise to become CEOs of companies because they are good operators. It is quite rare that you find a CEO who has a lot of training in capital allocation. And in fact, when you look at where hedge funds tend to be activist, hedge funds are, of course, guys like me are trained to be capital allocators, but we couldn't run a business for the life of us, most of us, right? And so we sort of have conflict with CEOs who know how to operate businesses but don't know how to allocate capital. That's not their training. So you can see companies often can do very well operationally, but then blow it completely on capital allocation. The most common mistake is doing paying too much, doing a large acquisition. Studies show that about 2/3 of acquisitions end up destroying shareholder value, yet management teams always think that they can come in and fix the broken business that they're acquiring. Another very common mistake is you buy back stock at $40 a share, and then you have no cash left to buy it back when your stock's at 10. How many companies today is that true of? And then so the third question we ask about management is are they trustworthy and shareholder friendly? And we've learned from hard experience that no matter how cheap a stock is if you have a CEO or board that are trying to, that don't care about you, the minority shareholder, there's almost no price that's too low that you will still end up doing well, because there are a million ways that they can do you wrong, despite the U.S. actually being one of the more shareholder-friendly countries out there, despite our system of laws and contracts and so forth. So once we've addressed all of these three questions, and let's say we really like it, the company's coming up, looking real good in all three areas. What's the fourth thing, of course, is I could name hundreds of companies that today, right now, meet all of those criteria. We obviously don't own hundreds of them, and why not? Because the problem is most companies that we appreciate that you can understand and make some predictions about, that are good companies in good industries, that have great management. Well, everybody else in the world appreciates the same thing that we figured out about these companies, hence the stock price already reflects it. And in fact, if anything, there's a slight bias toward overvaluation in most markets, probably not today, but most of the time, just because management and Wall Street are out there promoting stocks, promoting companies. So it's, the fourth step is probably the most important, which is the stock really, really cheap? Is it trading at a big discount to intrinsic value? Is there a large margin of safety? And to help answer that question, if you think you found a cheap stock, odds are at least 90% that you're wrong, that the market is appropriately pricing the stock and you've missed something. Okay? Your job as an investor is to find out those 1 out of 10 situations where you're betting against the market and you're right and the market is wrong. So one of the things you always want to ask yourself if you're buying a stock is what's my variant perception? What do I believe about this company or about this industry that is different from the general consensus out there? And so you're understanding exactly what assumptions you're making that are different from everybody else's that leads you to believe that you're buying it at a market cap of 500 million and you think it's worth $1 billion, for example. Well, what is it that the market believes that is leading them to value it at 500 million? You better figure that out and be very certain that you're right and that the wisdom of the crowd is wrong. Another concept, important concept with value investing is called focus investing. And it's a concept that applies not just to investing, but to a lot of different things. Ted Williams applied it to hitting. The last man to hit 400, he would only swing at balls that came in right in his sweet spot, even if they would be called strikes. And there's actually a chart, again, I have on my wall next to my desk that shows Ted Williams divided the strike zone into 16 or 24 different little quadrants, and his batting average in each of those little boxes, and it showed that he had certain sweet spots within the strike zone where he would hit north of 400, other parts in the lower outside corner where he was a 220 hitter, right? So same thing in investing is that when that pitch is coming in, the beauty of investing is you never have 2 strikes against you, where Ted Williams, he would have to swing at that low and outside pitch, even if it wasn't a high probability pitch, if he thought it's still in the strike zone, because he's going to get called out on strikes. The beauty of investing is there are no called strikes. You can sit there with the bat on your shoulder, waiting and waiting and waiting and waiting for the pitcher, in this case the market, to make a mistake, sends one right down the pike, and you can swing hard. So virtually all successful investors I know, there are a few exceptions, Peter Lynch, perhaps being the most famous one, but virtually all successful investors I know make relatively few investments, and when they do, they tend to bet large. They run fairly concentrated portfolios, and in fact, you can eliminate most of the risk of sort of systemic risk if you have a diversified portfolio with as few as 8 or 16 stocks, somewhere in there. Where people have most of their portfolio concentrated. So to some extent, it's also what lets you sleep well at night. But having too few stocks, you run the risk of, if you're wrong once or twice, you blow up and go out of business. And I've seen that happen to guys this year, friends of mine. On the other hand, if you're holding 100 stocks, all 1% positions, it's virtually impossible to beat the market. So focus investing is critical to success. So Buffett talks about this. He said when he's giving speeches to young folks like yourselves, he says, imagine if when you graduate from business school that you get a punch card, and every time you make an investment, you get 1 punch, and your card only has 20 punches for your entire life. Imagine how cheap something would have to be and the degree of conviction you would have to have in order to use up one of those 20 punches. Probably an extreme case, Buffett himself, when he was a young person, was constantly trading, buying stocks at 2 times earnings. They'd run up 50%, trade at 3 times earnings. He'd sell them and buy another stock trading at 2 times earnings. That was sort of Warren Buffett's early career. But certainly that was a very different time, and the mental construct of only investing when you have an enormously high degree of conviction, when something has a huge margin of safety, is perhaps the single most important thing to keep in mind when investing. So a little bit on variant perceptions, which I talked about, a couple great quotes here from Michael Steinhardt, Jean-Marie Avillard, and Bill Miller, but basically talking about how important it is to make money. You have to be betting differently from the general consensus, otherwise you're sort of an index fund, right? On the other hand, it's very emotionally difficult, particularly if you bet against the herd, and then the stock goes down a bunch, and you've now lost some money, and you're rethinking, gee, everybody else says AstroTurf.com is worth 10,000 times revenues, to pick a classic case in March of 2000. And here I am, I'm short AstroTurf.com, or certainly not buying the stocks that are running the most. Psychologically, it can be very, very difficult. So To be a successful investor, you not only have to come up with variant perceptions and do your work and all, but then you have to have the conviction, almost the arrogance of saying, I'm right and everybody else is wrong, because that's effectively what you're doing anytime you're buying a stock. So how do you beat the market? There's sort of three general ways. One is better stock picking. Second, you can be very clever timing, getting in and out of the market. Or thirdly, you can lever up, and you can easily turn 10% returns into 20 or 30% annualized returns via leverage. In reverse order, well, portfolio leverage, we're seeing this year what happens to people who try that route. And keep in mind, if you plan to be investing over an investment lifetime, if you're multiplying your returns each year, and even 1 year has a zero, the total value, the end value of that is zero. So it's amazing how many people sort of forget that basic math. A lot of people are learning it this year. Some people are very good market timers, but I think that's very hard to do. We've never been much good at it, though we do bottoms-up stock picking with often some general view of the market. If we think it's extremely cheap or extremely expensive, it may change our overall allocation in terms of how net long we are or net short we are. But generally, what we do and what most people are trying to do is simply do better stock picking if you're going to try and beat the market. So how do you do that? What are the different ways in which you might be able to generate an edge over time? One is if you're managing a small pool of money, that's an enormous advantage. There are 8,000 publicly traded stocks in the United States, just the US. 5,000 of them have no analyst coverage at all, generally a few $100 million, south of $1 billion market cap. So, Warren Buffett has said if he had $1 million, he knows people, certainly would be including himself, that could compound that at 50% a year, managing $1 million. But he said you couldn't do that with $10 million. I mean, that's how quickly the universe shrinks. So all of you just investing your own personal accounts and all, Buffett, again, has always asked this question, if you were me, what would you do? And he's like, I'd focus on stocks with $100 million market cap or less, and I'd just root around the nooks and crannies of the market looking for extremely mispriced, sort of obvious situations. So second advantages is time arbitrage. If you can structure your business or if you're just managing your own money in a way that you can look out 2 to 3 years, the stock market is generally looking out 1 or 2 quarters, and that's how it's pricing things. So it can be a very big advantage looking out a couple of years. A third advantage is concentration. The average mutual fund holds well over 100 stocks. I think the average I read is about 150 stocks. Very, very difficult to beat the market being that diversified. So if you can again set up your business or run your personal account such that you can deal with more short-term volatility but invest in a dozen stocks, that's certainly one way to beat the market. A fourth way is analytical. If you just simply do better analysis, you take the same data as everybody else, but you run better models, you think about things more clearly than everybody else. It's hard to do, certainly, because there are a lot of other smart people out there, but some people clearly are able to do this and generate an edge that way. Another way is via experience. Good investing is to some extent like being a good pilot, like a fighter pilot or a brain surgeon or something like that, where both the process of becoming good at it, where you're almost an apprentice to someone else who has a lot more experience, and you gain experience sort of working for somebody else, but then over time you sort of go out on your own. And again, the difference in experience from a brain surgeon who's doing his first 10 surgeries versus his 10,000th surgery, there is an enormous difference in outcomes if you've ever studied healthcare. Same thing is true in investing. So I'll tell you a little story about Warren Buffett just invested $3 billion in Goldman Sachs. There's $3 billion in Goldman, $5 billion in Goldman, $3 billion in GE. And someone emailed me, and I said I thought this was a brilliant investment. Somebody emailed me and said he didn't even do any due diligence. He didn't hire a team to go in and go through the books of Goldman Sachs, et cetera, et cetera. This was like almost negligent. How can you own the stock of a company, we own Berkshire, where a guy's going in and putting $5 billion of your capital to work with virtually no due diligence? And I emailed the guy back, and I told the story of Picasso at one time, was sitting there having lunch, and some woman comes up to him and gives him a napkin, says, will you draw something on the napkin, and I'll pay you whatever you think it's worth. And so Picasso sketched something out, and a minute later handed her the napkin and said, that'll be $10,000, please. And the woman said, what do you mean? That only took you a minute. And Picasso said, no, that took me a lifetime. Warren Buffett has 60 years of experience, 12 hours a day, just doing nothing basically, but reading annual reports, looking at stocks, et cetera. He probably knows Goldman Sachs better than just about anybody, including people inside Goldman Sachs, and what the risk factors are, et cetera. So with that kind of experience, he's able to make those kind of judgments. And so to the extent you want to pursue a career in investing and so forth, is one of the things you want to think about is how do I get up that experience curve as quickly as possible? Because I can tell you from my own experience, we look at things today that, young people I talk to and all, they come pitch me a stock or whatever, and it immediately triggers, oh yeah, I've seen a situation like this. This is a total value trap, and I can steer them back to analogous situations I saw earlier in my career, but they haven't seen those situations. They're at an early stage in their career. So there's experience is enormously valuable, and one of the things that I try to do with the newsletter I publish, Value Investor Insight, the conference, the teaching that I do, is in the same way that Warren Buffett wrote and taught, and other investors like Seth Klarman and Joel Greenblatt and others have written books and so forth, sharing their experience with the next generation of investors. I sort of try and do the same with folks like yourselves. Because there are only sort of two ways to get experiences. One is to try and learn from somebody else. That's how they train pilots. That's how they train surgeons, right? You don't want to crash the plane or kill the patient. In investing, unfortunately, people run out and open up their own Ameritrade accounts or whatever and start day trading, have no experience, and they lose a lot of their money often as a result. But to learn investing properly, ideally, you want to learn from somebody else, because the only other way to get experience is just to go out and do it yourself. And I can show you a lot of scars on my back from that method. So I highly recommend the first method. So last couple ones are emotional. That's one of the areas I'm going to talk about in more depth, about the sort of mental side of investing. And I'll just leave you with, summarize it with this thought, which is virtually all human beings are hardwired to be massively irrational when it comes to making financial decisions. And therefore, to be a successful investor, you have to understand the dozens of ways in which you are hardwired to be irrational, and the first step to overcoming those irrational tendencies is to understand them. Even when you understand them and study them for many years, you will still make these mistakes, but you try to minimize the mental mistakes, the emotional mistakes. And finally, informational is certainly some investors can go out and just collect more, better information than others. It's harder to do in a Reg FD world, but it can be done. So those are all the different ways in which you can generate an edge in investing. So let me summarize this section with an article, summary of an article that I wrote called Traits of Successful Money Managers. And by the way, in a number of these sections, including this introductory section, I've written a number of articles over time. I wrote for The Motley Fool for many years. I currently write for Kiplinger's, the Financial Times. I've written hundreds and hundreds of articles over the years. So there's sort of more detail on some of this, and I've collected some of the articles that talk about these things. So I've sent Dan a PDF, and Everett as well, and they said they'll make them available to you. So a copy of the slides that I'm presenting here, but also a lot of backup materials and articles will be made available to anyone who's interested. So if you want to be a successful money manager, I argue here that you need two things: the right approach and then the ability to execute on that approach. So there are sort of 8 subcategories under each of those. Let me just very quickly run through them so we don't get too far behind. The right approach. First, when you're buying a stock, think about it like you're buying the whole company rather than trading a piece of paper or these days an electron. Secondly, you got to be able to tune out the market other than to take advantage of its occasional mistakes. The market is there to serve you, not to guide you. Thirdly, only buy a stock when it's on sale, margin of safety. Number 4, think first about avoiding losses and then think about how much money you can make, but think about protecting your downside first. Number 5, only invest when the odds are in your favor, then invest heavily. We've covered that. Number 6, don't spend a huge amount of time trying to figure out whether the Fed's going to cut interest rates by 25 bips next Fed meeting, what the dollar-yen trade, exchange rate's going to be, or even, although this is obviously has an impact on many of the stocks we own, trying to predict, when exactly our economy, the recession that we're in, is going to end and when things are going to turn up and so forth. Even though it's important, it's very difficult for it to be knowable. And you need to spend your time focusing on things that are both important and at least somewhat knowable. Number 7 is be flexible. Try and expand your circle of competence and don't limit yourself to just investing in small caps or just investing in the United States if you have expertise in other countries, just investing in certain industries. The corollary to that is you always want to make sure you're well within your circle of competence, but within that, be flexible. And then finally, shun consensus decision making. I'm on a number of investment committees, and gosh, do we make terrible decisions. One person, maybe two, making a decision is optimal in investing. So I love Buffett's quote, "My idea of a group decision is looking in a mirror." But even keep in mind, by the way, he became a much better and more successful investor after he partnered up with Charlie Munger. And the two of them are an incredible team that have done better together than they did separately. One of the things that was a factor in my decision, 5 years after I started the business, my current business, has been in business for 10 years, finishing up our 10th year. The first 5 years was just me, brought in a friend as a partner, and I think we're much stronger as a team. So those are the characteristics of the right approach. The right person is, now here's what you need to be able to execute. Assuming you've got the right approach, what are the characteristics you need to succeed? The most successful investors are business people, and they think like business people, and that's how you understand businesses and industries. Number 2, they have a lot of intellectual horsepower. Buffett says investing's not a game where the guy with the 160 IQ beats the guy with the 130 IQ, but notice he didn't say 160 versus 80. The most successful investors I've ever seen of all time are really, really, really smart. So number 3 is good with numbers, obviously very comfortable, though advanced math, higher calculus is almost irrelevant. Buffett is sort of frighteningly good with numbers. He can tell you what the revenues of some obscure company were in 1957. He's sort of a savant. But you don't have to be that crazy savant-like, but it helps a lot to be very comfortable quantitatively, numerically, et cetera. Number 4, they're both confident and humble. And you've probably picked up some of the things I've been talking about. To buy any stock, it is almost an act of arrogance, right? That you're right and 10,000 other investors looking at that very stock are wrong, right? And specifically, the person selling it to you is wrong and you are right. So you have to have a certain degree of confidence, a high degree of confidence, particularly when you buy something at 10 and a week later it's at 8. And the market's telling you, the world is telling you that you're wrong. To have the confidence to stick with it, to redo your work, stick with it, and even buy more at 8 or 6. But at the same time, you have to be humble. You have to recognize that the market is usually right, and particularly you have to be humble to stay within your circle of competence. They're independent, neither take comfort in standing with the crowd nor derive pride in standing alone. They're patient, long-term greedy. John Templeton once said, if you find shares that are low in price, they don't suddenly go up. Our average holding period is 5 years. Very true words. Number 7, they make decisions based on analysis, not emotion. And number 8, the most successful investors I know, if they didn't earn a penny doing it, or if they earn virtually nothing, just enough to pay their rent or whatever, would still be doing it because they just love the challenge, the game, the intellectual part of it. The money is the fact that it is one of the world's best businesses, at least not in years like this year, but most other years, is sort of almost incidental. They just love the game. As Buffett says, I tap dance to work. So let me briefly cover valuation, and this is, of course, if you can do valuation, you're a huge part of the way toward being a successful investor. I could teach a whole day-long course on this, but I just want to sort of cover some of the highlights and then start diving into some of the case studies and the behavioral finance elements of this before we run out of time. So the most important element of valuation is if you're looking at companies, is think about discounted cash flow. This is where you should focus, generally speaking, 90% of your time. And it applies not just to valuing companies, but to anything. You're just taking the future free cash flows that a business or whatever the asset is will generate all the way from here till eternity, and then discount it back to the present at an appropriate discount rate. So to pick a very simple example, how would you value a 10-year Treasury note bought today? Well, call it yielding 4%. So what does that mean? It means the future cash flows are, if you buy a $100 Treasury note today, you get $4 per year, each year for the next 10 years, and then you get your $100 back at the next 10 years. That's your terminal value, right? So what would you do? You'd sort of add up your little spreadsheet. You'd take your $4 payments, your $100 terminal value. So what discount rate would you use to discount that back? 4%. Right? Because it's the world's safest investment. It's a Treasury note. So if you take a 4% yielding Treasury note, you discount it back at 4%. So what do you get? A $100 Treasury note today is worth $100. Right? So that math that I just laid out is sort of simple and so obvious, right? The question is well, now let's apply that math to a business. Well, now it gets a lot more fuzzy. Who the heck knows in this economic environment what a company's going to earn this year, much less next year, much less years out. And then, at some point you got to assign a terminal value. But for a company like Coke or McDonald's or whatever, a big part of today's value is the value from years 10 to years 100, right? So it gets very, very complex. I will tell you that Buffett has never used a spreadsheet, and they'll teach MBAs and students and all. You can crank out these elaborate spreadsheets and all. And generally speaking, you have to be very careful of the garbage in, garbage out rule, which is you can make that spreadsheet. If any of you end up working at investment banks on deals and stuff, you will learn up close and personal that you can. Too often you start with the desired valuation, and then you back into the assumptions necessary to get you to that valuation. So we don't use spreadsheets either. It sort of has to be sort of obvious enough to us that we don't need the precision of a spreadsheet. If it's that close, there's just not enough margin of safety. But that's sort of but this is the whole ball of wax. In most companies you look at is just going to be figuring out that discounted cash flow and making some reasonable estimates about what a company is going to earn from here to eternity. So what are some other areas you might look? Looking at public company comps. Just make sure that the comps are valid and that the entire sector isn't misvalued. eToys looked cheap relative to Amazon.com at one point, on a public company comp valuation, but it still went to zero. Acquisition comps, there aren't very many acquisitions going on these days, but someday companies will be acquired again, and look at what multiples other acquirers, either strategic or financial, might pay. Historical comps, where is the company historically traded at? We think Amex is interesting today at trading at about 11 times earnings. Over the past 20 years, American Express average PE ratio has been 21 times earnings. It's a superior, world-class business that's encountering real headwinds today. And those headwinds aren't going to dissipate probably for a couple years. They're going to have to take write-downs in their credit card portfolio, et cetera. But when you can buy one of the world's great businesses, Warren Buffett owns 13% of it, by the way, at half of its historical multiple, that's pretty interesting, I think. So that's certainly one data point we'd look at. Some of the parts, a lot of different companies have very different. We're going to have very different pieces that you can value separately. You add it all up, and often you can buy something at a big discount. There's one of the problems with the sum of the parts analysis is companies very rarely spin off or split up or themselves, and so whatever discount is there may persist forever. One of the case studies I'm going to be teaching is Target, where one of the largest shareholders just last week proposed spinning off its real estate into a REIT, and I'll walk you through that. But certainly that's an example of a sum of the parts analysis. Generally speaking, rule of thumb that I would use is for you want to categorize businesses, and you're willing to pay more for really high quality businesses, but sort of rule of thumb that you might compress these today in this environment, because look, you can buy a very high quality business like American Express or Target at 11 times earnings, but normally speaking, for world-class businesses that are probably worth 20 times earnings, if you can buy them at 14, 15 times earnings, you're buying at maybe a 30% discount to intrinsic value for a very superior business. that would be paying up for us, buying something at 70% of what we thought it was really worth. There are only a handful of businesses in the world that we would pay that price for. Most of the businesses in the world are more mediocre, more average businesses, and that's okay to own those kind of businesses. You just better pay a much lower multiple, much cheaper price for them. So sort of PE multiple rule of thumb is sort of pay 10 or 11 times earnings for a fair business, up to 14 or 15 times earnings for a superior business, and well into the single digits, call it 5 to 7 times earnings is what we might pay for a pretty mediocre business. So there are, I don't want to throw out, rules of thumb are very, very dangerous, but just sort of after you've been in the business for a long time, you've looked at enough situations and stuff, you start to develop these sort of mental rules of thumb that enable you to quickly evaluate whether, if something's trading at 20 times normalized earnings, I don't care how great the business is, we're never going to buy it, so I'm not going to do a lot of work on the company. You got to, when there are 8,000 businesses, if you just limit yourself to the United States, you got 8,000 stocks to choose from, you got to very quickly be making circle of competence and valuation judgments so you can focus your time on things that actually might yield an investment opportunity. So with that, let me switch to, actually, let me take, if anyone has any questions, I'll take a few questions before I switch to the next part of the presentation on behavioral finance. Any questions? Sure.
How do you go about developing your circle of competence? Do you focus on things you're interested in and then pursue that, or what's your approach to that?
The question was, how do you develop your circle of competence, and how do you choose what areas to focus on, and then how do you actually, if you decide that an area is interesting, that you want to develop your circle of competence, how do you do it? I think for every person, the answer is where to focus. Like, where do you want to develop competence is based on your own unique interests and your own unique situation. If you spend a number of years working in an industry, or if you just have a real interest. Some people just love going and visiting stores, and so they naturally are drawn to the retailing industry. They like visiting, I know investors who run, there are a couple guys that focus exclusively on banks with $1 billion market cap or less. And believe it or not, there are like 1,500 of them. And it's a long-short fund, but exclusively focuses on one little niche because that's what they're interested in, and that's where they've developed enormous expertise. And they spend all their days going out, not just sitting in their office, but actually going out and driving the coast of Florida and places where the housing bubble has been the worst, to develop proprietary insights and relationships and knowledge and so forth. That's a strategy, by the way, that's paid off big time this year on the short side of their book. I know another person who just focuses on retail stocks. Again, long, short. But so the answer is pick areas that are interesting to you, but also where you think they're, that also you always want to pick ponds to fish in that you think are there might be big fish in there, right? So pick sectors in which one, that the future is predictable or knowable. So I spend no time developing a circle of competence in biotech because it's virtually impossible to predict, the long-term future of companies in this industry, with the exception of maybe, Genentech and Amgen, and that's about it, right? Whereas retailing, we love. Why? Because every month companies report same-store sales. And investors overreact to short-term same-store sales, so you get wild mispricings, and you get Abercrombie and Fitch trading at $75, and 6 months later it's at $24, for example, and gives you good short and long opportunities. Sectors that are very volatile with lots of other irrational investors. Technology is another one. Now, tech is tough because it can be very difficult to predict the future of these companies, but not impossible. So we find both short and long opportunities in that sector, in part because the sector is a magnet for a lot of irrational investors. So, and plus, both my partner and I are sort of gadget fiends, and we're sort of interested in technology and so forth. So that's sort of the answer to, where might you want to look to develop your competence, and for each one of you it'll be a different answer. How do you develop it? It's a whole lot of reading, mostly, but also going to industry conferences, reading the industry trade rags, et cetera, et cetera. Every industry is a little bit different. Going and visiting stores, walking, if you're interested in developing expertise in retail. Going and working for somebody else that has a focus in those areas and getting experience sort of on their nickel, that's the best way to learn in general. So pick who you go and work for, because that will determine, your boss will determine a lot about where you develop expertise. Other questions? Yeah?
Yeah, you mentioned that with 16 stocks you can significantly diversify your risk. And then you mentioned Berkshire and Amex are two stocks that you own, and that Berkshire owns Amex as well.
Right.
How do you make sure that with those 16 stocks, that they're not overly correlated?
Yeah.
That you're doing it properly?
Well, in that particular case, Berkshire owns 13% of Amex. Berkshire has a $180-something billion market cap today. Amex is probably 5 or 6 billion. It's probably, I'm anchoring on the last, Amex is down 50% this year, so Amex is probably down to a $3 or $4 billion position for Berkshire. So in that case, there may be some correlation because they're both generally in the financial sector, but there's virtually no correlation because Berkshire owns a piece of Amex, given that Berkshire's value, Amex doesn't own any of Berkshire, and Berkshire, it's only maybe 2% of Berkshire's value is embedded in its holding of Amex. So generally speaking to your question, there's no mathematical formula that you can plug it into. You sort of have to look at your portfolio and say, gee, you know, we own, because we sort of like the retail sector and retailers are cheap today, you know, we own 6 different retailers that are collectively 30% of our portfolio. You know, we might want to think about scaling that back from a risk management perspective. So just sort of thinking about, you know, what things will correlate and what things will be inversely correlated to try and reduce the volatility in your portfolio is another thing to think about. So no easy answers there, but you know, I can't tell you how many times back in the bubble days in particular, you know, I would get emails from people who read one of my articles and say, you know, what do you think of my portfolio? You know, I've got my conservative stocks, which are Microsoft, Intel, Oracle, and Cisco, and then I've got my aggressive stocks, you know, AstroTurf.com and so forth. And, you know, do you think this is a reasonable portfolio? And, you know, people would, believe it or not, think that that's diversified.
I don't know if this factors in at
Yeah.
all, but do some of the shorts that you do against the retailers, does that mitigate correlation too?
Yeah, it's a good point, but you know, knowing, for example, if we are in fact quite heavy in the retail sector, been way too early. It's been very painful, but we have offset those losses this year particularly because knowing we were investing based on particular. We were never bullish on retail a year ago, but we bought particular stocks, Target being one of them. Because we saw particular embedded value in the case of Target in their real estate portfolio, and because there was a very savvy activist, Pershing Square, getting involved with the company. So we wanted to be long activism. We did not want to be long the U.S. consumer, and we didn't want to be long U.S. real estate. So we bought Target, but we shorted a basket of retail stocks, an index fund, and we also shorted a number of the mall REITs, figuring, well, if we're wrong on Target, why will we be wrong? The U.S. consumer collapses and real estate collapses, and we wanted to hedge out those risks. So in fact, while Target is down 40% from our initial cost, we've bought it at much lower prices as well, but from our initial cost, but we actually didn't lose that much because we identified some sort of macro risks that we weren't comfortable with, hedged that out. And it looks like we may end up actually doing well on this because the activism is sort of picking up. It turns out we were right on the activism, and we were certainly right to hedge out the things that we did. So in the interest of time, let me go through this piece, and I'll take a few more questions. And then at the end, by the way, I'll stick around after we're completely finished and take questions as long as people want to come up and talk one-on-one. So let's talk about behavioral finance, and this is 19 or 20 slides. Normally it's an hour-long presentation, and I'm going to do it a lot faster than that. I just want to give you sort of a flavor, and this is actually a presentation. It's 19 pages. I have in the PDF that I sent to Dan, made available to you, I have 55 pages of both articles that I've written and that have been published in the newsletter, Value Investor Insight, that I'm the co-founder of. So there's a lot of richness here for if you want to learn more about this, and I would urge you to learn more about this because all of you have the smarts to be successful investors. All of you have the IQs. What will determine, to the extent those of you pursue investing seriously, what will determine which of you is successful or not is this element of it, the behavioral mental element of it. So behavioral finance is sort of the fancy term for it, but it just means how and why investors are irrational when it comes to money and financial decisions. That's what we're talking about here. So this is a list, and this is only a partial list of the many, many different mental mistakes people can make. So I'm going to go through the first handful of these just to give you a flavor of it, but just so you know how many ways there are in which the mental traps you can fall into and the things you need to study and understand so that you try and fall into them less frequently. You'll never completely eliminate it. Warren Buffett himself admits, every year he does admits to his mental mistakes at the annual meeting. And if he's making mental mistakes, even with his experience and all, imagine how hard it is for us. So let's talk about overconfidence. This is a biggie. And there are all sorts of wonderful statistics here about how overconfident human beings tend to be. And by the way, it's normally a healthy thing. Many of the great achievements of mankind would not have been achieved without an abundance of overconfidence. Think Christopher Columbus, for example. But 19% of people think they belong to the richest 1% of households. You can read down the list. My favorite was when I went back to my business school HBS 5th reunion. I'm going to my 15th this coming year. They actually had a survey that asked you a bunch of questions, and they put up the results. And I still remember one of the questions was, are you better looking than your average classmate? 86% said that they were. And always some wise guy yells out, well, what did you say? And I always take the fifth on that. When it comes, look at these examples, from doctors to lawyers to people trying to finish their honors thesis, how long it's going to take them to finish it, the ability to diagnose a disease, the likelihood of their business being a success. Every study ever done shows that human beings are massively overconfident. So how does this apply to investing? Well, in a number of ways. Most dangerously, it can lead you outside your circle of competence into thinking you understand a company or industry that you really don't. It can lead you to become so overconfident that you lever up to enhance those guaranteed returns that you're certain to make from owning this particular stock or portfolio. Can lead to excessive trading, which every study ever done shows leads to suboptimal returns. And can lead you to, if you're not using leverage, another variation of overconfidence is putting 50% of your fund or more into a single stock, which some people do, and sometimes it works until it doesn't, and then you're out of business. So now, what's the relationship between information and overconfidence? You would think that, not surprisingly, the more information you get, the more overconfident you become, and apply that to this world where literally we're drowning in information. You just fire up your computer, and all of a sudden, you can get information on virtually anything now very quickly. And what the studies show is that the more information you get, the more confident and overconfident you become. However, your ability to predict the future does not improve once you move beyond the few key pieces of information that really matter. And that's what's most important, which is, so they did a very interesting case of people who handicap horse races, and the handicappers all agreed that there were 5 pieces of information that were most important in predicting who would win the horse race. And that was, what was the horse's track record, how many races had they won in their previous, 10 races, et cetera, et cetera. But then they asked them, well, what about, are there other pieces of information? And the handicappers came up with 35 more pieces of information. So then they actually gave them 5 pieces of information and asked them to handicap a bunch of races. And they determined the accuracy of the handicappers. Then they took the same handicappers and gave them those 5 pieces of information, but gave them 35 more pieces of information as well. So they had the same information plus a lot more. Okay? And what happened? The handicappers became doubly confident, but their odds of actually predicting went down. Okay? And why was that happening? Because there was some vivid piece of information or something dramatic that was down there at importance number 20. It turned out important piece of data, but it was sort of dramatic, so that's what they focused on. And it led them to make worse investment decisions. So I'll give you a simple example from many years ago. It's still painful to me. We were meeting with, we were about to buy, this was right after 9/11, mall traffic was down, and Claire's stores sells little hair scrunchies and berets and so forth for young girls, okay? And they're a mall-based retailer, and they're actually a very good business, high returns on capital, very nice growth over many years, et cetera, et cetera. And the stock had traded down to 11 or 12 times earnings. We were all set to buy it. And turns out the guy who ran the business and built the business was like 85 years old and probably wasn't going to be running the business much longer. And his 2 daughters were now running the company. And it turns out one of his daughters was in town. So we said, okay, let's set up a meeting. And we set up a meeting, and we had a meeting with her, and basically we thought she was a bozo. And so we didn't end up buying the stock. And the stock, of course, quadrupled, within a year. And I always remember, like, there was a very vivid piece of information that, gee, this guy's daughter is a bozo and she's a senior VP at the company. But it was irrelevant, okay? She wasn't running the company. The guy who built this very successful business, what was relevant to this investment thesis was mall traffic going to rebound after 9/11? We thought that it was. Is the company going to continue to be managed in the effective way with a good merchandiser and a good CEO, as in the past? Absolutely. The guy was still running it. He wasn't on his deathbed or anything. Turns out he ran the company another 5 years or so. And was the stock really, really cheap? And basically, those were the only 3 things you needed to focus on. And instead, I went out and collected some additional information that screwed up my investment decision-making process. So it's very important to collect good information, but it's also very, very important to figure out what's relevant and what's not, and not get distracted with the other stuff. So herd-like behavior is another classic human mistake. You see it all the time. You saw it in the internet bubble. You saw it in the housing bubble on the way up. I would argue you're seeing elements of it, certainly in certain sectors of the market right now, on the way down, where it's what's called social proof, which means if everybody else is doing something, well, they must know something I don't, and therefore you sort of follow the herd. And most people have no ability to calculate the intrinsic value of a business, have no concept of what margin of safety is in the investing world, and therefore they're little more than sort of they're following the herd and maybe trying to be a little clever in finding out where the herd is going to go next. And if that's where 80% of the world's money is being managed in that fashion, you can see how you can have extreme moves in stock prices and in markets. There's, one of the most interesting pieces of data here is they did a study here from over, looks like it was a 12-year period, and it said the average stock mutual fund compounded 12.3% a year, which is about what you would expect, given that the S&P did 15.4. The average stock mutual fund, has trading costs and fees and so forth that'll reduce its return. That's almost definitional. What was interesting is that the average investor in the average fund only earned a 6.3% return. And you might ask yourself, well, gee, isn't that sort of like saying that the average airliner flies at 30,000 feet and the average passenger on the average airliner flies at 15,000 feet, right? I mean, how is it possible that the investors collectively earned dramatically less return than the average mutual fund? And the primary reason for it is of course, that people have other assets. They don't have all their money in the market all the time. So what it means is that people took money out of their bank account and they put it into the first-hand internet fund in March of 2000, and then the fund went down 80% 2 years later, and then they took what was left and they took it put it back in their bank account in October of 2002. So that's what this is. It's hard to find better proof of herding tendency, even when you don't have bubbles at work. Just every day, what do people do is they sort of chase performance. They buy at precisely the wrong time. They sell at precisely the wrong time as a group. Professional investors, not only so there's a double whammy effect going on here, which is the individual investors investing in the mutual funds go into the hot funds at the wrong time, pull money out at the wrong time. But then compounding it is the professional investors running the funds pile into the hot stocks right at the top and sell the stocks right at the bottom. So the double whammy of that effect results in what you see here. And what's interesting is this doesn't really happen with bonds. Like, people get really excited about stocks and sell them too high, buy them too high, sell them too low, because people come up with just crazy prices that they're willing. There's no price too high for a stock that consistently beats earnings estimates by a penny for a couple years, right? Well, bonds, that doesn't really happen as much. People don't go crazy for bonds. So sure enough, they did the same study for bonds, and the average bond fund earned 9.7%, and the average investor earned 8%, much closer. There's still a little bit of chasing returns, but much smaller in the area of bonds. So in the interest of time, because I really want to get to, I want to get to some of the case studies and dive into some real companies, some of the stocks we own in our portfolio now. I'm going to quickly just click through this, but and this whole presentation and lots of articles, as I mentioned, will be available to you afterward. But you know, one of the key factors of this herd-like tendency is looking at what other people are doing and assuming that they know something. So here's sort of a funny study of these guys are part of the study, and this is the guy who doesn't know what's going on. So they bring him in, and it's very simple. Bar X is the height of A, B, or C. And what they tell these guys to do, who are part of the study, is they say, oh, it's A. And this guy's here looking at it, it's like, that doesn't look like A, it looks like B to me. But as long as everybody else around the table says it's A, 35% of the people, average Americans, you know, hundreds of them brought in to do this study, 35% of the people will go along and say it's A. Okay? Now, if one person, if there are 10 people around the table, and so there's 9 people plus the subject of the study, okay? Of the 9 people, if all 9 of them say A, 35% of the time the guy says it's A. If one of the 9 says, nah, I think you 8 are wrong, I think it's B, then the guy will be like, oh, okay, somebody else is there with me, I'll say B too, right? So it's just fascinating sort of human dynamics about how people will, even things that are just obvious as the nose in front of your face, people will go along with what the group is doing, what the crowd is doing, and you see it all the time in investing.
You briefly want to mention that you recently made a public policy comment about the impact on shorting that has?
Oh, just in terms of the uptick rule and so forth?
In terms of B, the value of B in the market. And, you know, shorting is a public policy tool.
Yes, good point. Basically, we short stocks, and often we are public about the companies we are short, which is extremely rare. 99% of people who short stocks never breathe a word about any particular stocks they're shorting, because they become subject to attack and, you know, rapacious short sellers, and they get blamed for markets going down and stocks going down, et cetera. But it's actually extremely healthy for properly functioning markets to have somebody not only with the ability to short, but more importantly, whether or not they're actually short the stock, to have any Wall Street analyst put out a report saying that, hey, you know, the rest of the world is saying A, that this housing bubble is going to be minor when it bursts and isn't going to cause any real lasting damage. Okay, that was A, what people were saying a year ago. And it's incredibly valuable to actually have somebody out there saying, hey, I think this is a train wreck, and things are going to get real ugly, and people should avoid financial stocks and housing stocks and so forth, right? So for, you know, speaking of a big macro call, or you know, we think we have a strong buy on MBIA at $70 a share, and have Bill Ackman of Pershing Square saying, you know, we're short MBIA, and here's why, because we think it's a zero. You know, somebody out there saying B. Now, whether or not, what's interesting is it's not really relevant whether A or B is correct. It's that there's a market of competing ideas. Analysts are pumping MBIA. Some short sellers out there saying, I think it's going down. That's what's necessary for healthy markets. So, more on bubbles. Loss aversion is a critical thing to understand. That you feel the pain of loss twice as much as the pleasure of an equal dollar gain. There are numerous examples that show that. But for example, one of the biggest mistakes investors make is that if you buy a stock at 10, it goes down to 8. And let's say you bought a stock at 10, you think it's worth 18 to 22. So you think you're buying a 50-cent dollar, okay? Your midpoint of that range is 20, so you think it's worth 20, you're buying it at 10. And then the company announces some piece of bad news, really bad news, that causes you to rethink your entire investment thesis. And now you don't think it's worth 18 to 22. You think it's worth 4 to 6. Okay? And let's say for some reason the market hasn't figured out how bad this news is, and the stock goes from 10 to 8. Okay, what should you do? Logically, what should you do that instant? Sell that stock, right? It's now trading at a 60% premium to the midpoint of your intrinsic value of $5. It's at $8, right? And the US government's paying you to sell it, right? Because you can take a tax loss. Okay, so there's extra incentive to sell it. Okay, what do most people do? They wait until it comes back to 10 before they sell. Okay, because they don't want to book that loss because they're down 20%, they're feeling bad about this loss, etc. And even though they would never buy it at 8, they'll hold on, hoping it comes back to the price at which they bought it before they sell. Commitment is, I'm going to stand up here in the next hour and tell you about 4 stocks, 3 that were long, 1 that were short. And does that change my ability to rationally evaluate these stocks and change the likelihood that I'm going to admit that I'm wrong and sell them someday? You bet it does. And so it's something I think about a lot because I'm always writing. I write an article in the Financial Times about what a great company Leucadia is, as an example, last week. And then a day after it comes out, we come across new information that leads us to believe that Leucadia's book value went from 30 to 15, not 30 to 25, and we are buying it at 20. Okay, so think about the math here. Leucadia is a company a little like Berkshire Hathaway. We have enormous respect for management, et cetera. It's a company we've longed to own for 10 years, but it always trades at 2 times book value. And it was just too expensive for us. But meanwhile, the stock book value kept going up 20% a year, and so we just kept kicking ourselves for not buying it. So then the stock has gone from 57 to 18 a week and a half ago. Okay, and the book value last quarter was $30 a share. Now Leucadia owns a lot of different assets. Some of those assets have been impaired. So we sort of our initial analysis was that book value had fallen maybe to $25 a share. So we could buy it, or let's say around 20. Okay, so we're buying Leucadia, which normally trades at 2 times book and should trade at 2 times book. We're buying at 80% of book. Okay, so that was our investment thesis, and we had to move fast. The stock opened up down 25% 2 weeks ago, and one morning some hedge fund was puking it out, right? So we didn't have time to do huge in-depth analysis, so we went in, we just grabbed a bunch of the stock, right? But we kept doing analysis, we kept doing work on it. Leucadia is a pretty complex company. One of our friends called us up, and he had done some interesting analysis and come up with some insights that we hadn't come up with. And all of a sudden, we realized, holy cow, book value didn't go from 30 to 25. It went from 30 to 15, in our opinion. And here we are holding the stock now at a substantial premium to book. So what do? Turned around and sold it. Now, it was a very easy thing to do. Why? Because the stock had gone from 20 to 27, where it is today. Okay? That makes it easy to sell. But on the other hand, even so, it's sort of hard when you've gone out publicly and written an article about what a great buy this is to realize, one, you've misinformed your readers. That's a whole another thing. I feel bad about that. But also, even if I hadn't written an article about it, if I talk to people about it, et cetera, you've made a commitment, it can change. There have been a lot of studies that show that once you own something, once you bought it, even if you don't talk to anybody else about it, the mere fact of buying a stock is a form of commitment. All of a sudden, your brain starts to shut down any conflicting or contrary information. And you start to seek out confirmatory evidence and block out any if a short seller comes and says, you buy MBIA at $50 because it's down from $70 and it looks cheap. Then all of a sudden, Bill Ackman comes along with a 60-page analysis that says this thing's probably worth 0. Okay, so what should you do is you should go try and have a meeting with Bill Ackman and ask him to walk you through that presentation and test your investment thesis, right? What, in fact, do most investors do? Because I've seen it happen. Over the past 5 years, I've seen this happen, is they refuse to take a meeting with him and they attack him. I kid you not. These are some of the most famous investors in the world have behaved that way. And MBIA today is at 6. Or no, it's at 8. 8.16 today. It closed down 21%. And it's going to 0. As I'll show you soon. Why? So anchoring, whole lot of ways where people anchor the price at which they bought it, the price at which it used to trade, et cetera, et cetera. Misunderstanding randomness and making bad decisions based on that. A whole lot of other mistakes. And like I said, in the interest of time, I'm going to shoot through this. But there's some great books that I would recommend in this area once you're finished reading through the 55 pages of stuff that Dan will make available to you. So let's talk about some stocks. Berkshire Hathaway is one of our favorites. Everyone's sort of heard of it. Not many people. It is probably the largest most widely known but least well understood company in the world, I would argue. And that creates an investment opportunity if you're willing to understand it. So it has a fascinating history of being a broken down, going out of business textile company that Warren Buffett bought a controlling interest in when it had an $18 million market cap, and it was a busted business. He was buying it at a discount to liquidation value. That's all it was. He never ever had any intention of using this as his investment platform to become one of the world's most valuable companies. So what is it today? They own roughly 75 operating companies, so it's a diversified conglomerate that owns a whole lot of other businesses. And then there's an investment portfolio of some well-known stocks that he owns as well. But that's become a much less important part of the business over time. The wholly owned operating businesses are more important. So historically, people looked at Berkshire Hathaway as somewhat akin to a closed-end mutual fund, and you sort of add up the stocks in it, and then it's a mutual fund run by Warren Buffett, closed-end mutual fund, right? That is no longer the correct way to think about Berkshire Hathaway, as it's now much more analogous to GE, a diversified operating business with a financial component of it, in Berkshire's case, insurance businesses. So this was a month ago. Actually, the stock price today closed at 117,100. So over the past month, the stock price hasn't moved. So that was nice as I was scrambling to put this presentation together this morning. I didn't have to change any of these slides. So here are the last 4 years of operating performance. And you can see Berkshire Hathaway has a very large reinsurance operation. So they provide insurance to other insurance companies. Let's say Allstate, that writes homeowners insurance in Florida and places with hurricanes, and Berkshire reinsures a certain amount of that coverage. And sure enough, when a hurricane comes along, that's Katrina and Rita right there, they lose a lot of money that year. But then when there are no hurricanes in subsequent years and insurance pricing goes up a lot after a hurricane, they make an absolute fortune. So this is a very volatile, lumpy business, but it's been very, very profitable for Berkshire over time. So that's point number one to make about Berkshire. Point number two is Buffett has been steadily acquiring lots and lots of other businesses, lots of them in the energy and utility sectors, but also every other kind of business imaginable that you saw on the previous page or two. And you can see the earnings here are growing dramatically, partly because they're good businesses that are growing their profits, but partly because he just keeps acquiring more and more businesses every year. This is not a roll-up strategy, however. He's not issuing stock. He's in almost all cases is buying cash, so the share count is staying constant. And he's not trying to make synergies and bring in new management or anything. He buys good businesses with good management and leaves them alone. The only thing that's different when he owns them is they don't have to deal with the headaches of being a public company to the extent it used to be a public company. Most of the companies he's buying are private. But the only difference is you have to take your cash every week and send it to Omaha, and he decides where to allocate your excess cash. And any major capital spending decisions he has to approve. But otherwise, if you've got a third-generation family business and you have lots of heirs and cousins and so forth who own some piece of that business and they don't want to own a piece of an illiquid business, they want to cash out. So there's pressure to sell the business, but you don't want to have your business sliced and diced and messed around with like an LBO firm would do it. And there's really only one, there are very few logical buyers in the world. One of them is Berkshire Hathaway. And so there are a lot of businesses where they will sell to Warren Buffett and to Berkshire Hathaway at significantly less than they could sell it for to some LBO firm. Today, there are no LBO firms to buy these things mostly, but in previous years. So Buffett has a real edge here. He buys businesses for less than market value. Not a lot less, but less. So here are the quarterly numbers, and you can just see the big losses in Q3 of 2005. Katrina and Rita made up for the big gains when they didn't have hurricanes in subsequent years. So over time, we can see that Berkshire Hathaway, at one time, Warren Buffett in his annual report splits Berkshire Hathaway into investments that they own. So this would be the stocks and cash and bonds, which you just value at market value. That's easy to value. And then here's the earnings of the operating businesses that Berkshire owns. So that's the way, as I'll discuss a little bit in the future, it's a pretty simple way to value Berkshire. You value the cash and stocks and bonds at face value, and then you put a multiple on the operating earnings. And so you can see, though, that early from 65 to 79, The big growth in Berkshire's value was because he was a great stock picker, basically. And the operating businesses grew, but not very much. And now you can see in recent years, it's switched. The real growth is coming. He's doing much less, creating less value because he's doing less investing in the public markets, in part because stocks have been fully priced. Back in here, this was the death of equities. Stocks were incredibly cheap back in the 70s after the 73, 74 downturn. So that's where he focuses his energies. Recently, he's really developed buying businesses in their entirety, operating businesses. So we can see here that Berkshire is one of the fastest growing large businesses in the world. These are the top 25, I think, largest businesses by market cap in the world. And this was back when Berkshire Hathaway's market cap has fallen some since this table. But the important thing is look at the compound annual growth rate of earnings over the last 5 years of these companies, and you'll see that Berkshire Hathaway's earnings growth of 30% compounded of the operating businesses is among the highest of any of these companies. So it's one of the fastest growing large businesses in the world. So how do you value Berkshire? You take the investments per share, put a multiple on the earnings. Buffett provides it to you. And the question is, well, what multiple do you put on those earnings? If you really read his annual reports going back 20 years, he gives you some hints in some of his annual letters. But the answer is roughly a 12 multiple. If you read these slides in more depth, you'll see where we came up with it. So how do you value Berkshire? Just each year, you take the investments per share, put a 12 multiple on the earnings. This is pre-tax earnings, so that would be about an 18 PE multiple, and that's your value. So, you have to use, we adjust for the hurricanes a little bit in here. So the actual earnings were substantially higher in 06 and 07, but there were no major hurricanes during those years. So we reduced the earnings somewhat, and we increased the earnings a little bit in 05 because they had a big one-time hit of unprecedented hurricanes. So you sort of have to normalize the earnings a little bit. So here are the numbers you come up with. So what does that lead you to? Well, this red line is each year the intrinsic value per share going back about 12 years. So, and this is the stock price each year. And what you can see is at some point every year the stock price hits the intrinsic value. So it's reasonable validation that this is a reasonable valuation metric for Berkshire Hathaway, that the stock price sometimes goes way up above intrinsic value every once in a blue moon. That's March 10th of 2000, the day the NASDAQ peaked is the day Berkshire bottomed well below intrinsic value. But look what's happened in recent years. A huge gap emerged in terms of the stock price and what intrinsic value was doing. And then late last year, the stock ran up to there, and in hindsight, we should have sold a lot more of our stock there. And then it came crashing back down, and then it sort of, when Berkshire did the Goldman investment, it sort of spiked back up to about 150, but today it's back down to 117. And look at where intrinsic value is, and this does not count any of the investments that he's made this year. He stole Constellation Energy. I think the GE and Goldman Sachs investments are going to turn out real well. So this year, Buffett has put more than $50 billion of capital to work that was sitting there earning 2% interest. He had it in short-term treasuries. Okay? And now he's put it to work in a collection of pretty good businesses that I think are going to generate at least 10 or 12% annual returns. Probably more based on the prices he's buying at recently. So he's taking $50 billion of cash, earning 2%, and now it's earning 12%, let's say. Okay, what does that do to expand Berkshire Hathaway's intrinsic value? A lot, right? But we're not even factoring any of that in, and it's trading today at a 25 to 30% discount to intrinsic value. Now, if you go back historically to when it has reached points well below intrinsic value, you can see that they're invariably followed by very sharp periods of getting back up to around intrinsic value. So this chart sums up better than any other why Berkshire is one of our largest holdings. You have one of the few genuinely AAA rated companies in the world. Even after putting $50 billion to work, he has tens of billions of dollars of more liquidity to put to work in an increasingly distressed market. You've got the world's greatest investor running the business for you, who's incredibly conservative, treats his shareholders great, and you can buy it at 25 to 30% discount to intrinsic value, and that intrinsic value is probably growing at least 10% a year, so you get paid to wait not paid in the form of dividend, but paid in the form of growing intrinsic value. So the only argument, the main argument, what my partner and I struggle with is do we want to own something that's 25 to 30% undervalued when we can find stocks out there that we think are 50 or 60 or 70% undervalued? That's the real question for us. There's very little question in our mind that Berkshire is going to do very nicely. So if you want to be a conservative investor, and sleep well at night, and you know you'll do well, and not have to do a huge amount of work, Berkshire is a good foundation create a good foundation for a portfolio. Then you can get more aggressive with the rest of your portfolio. So there are other ways to value Berkshire. So let's talk that are covered there. You can go through that at your leisure. And by the way, any questions about Berkshire before we move on to Fairfax? Yeah.
Are you at all concerned about Warren Buffett retiring?
Well, he's not going to so much retire as he will retire within a month of his death, is my guess, if he doesn't actually die in office. Yes, we are concerned about it, and let me see. He just turned 78 last August 30th. He has a succession plan in place. His job will be split into an operating CEO and one or more chief investment officers to invest the capital. He's really taken steps to ensure that there'll be a smooth transition. There will be no replacing Warren Buffett, but the most important thing is that our valuation assumes zero Buffett premium. There is no assumption in our model that he's going to be able to put the Berkshire Hathaway's current liquidity is going to be put to work at some high rate of return or whatever. Our valuation assumes that Buffett dies tomorrow and that it just continues to operate as it currently is operating, which is, I think, a pretty safe bet. However long Buffett lasts, and his dad, I think, lived to 95. Buffett is now, for the first time in his life, watching his diet, working out with a trainer periodically. Like he's actually, recognizing that, hey, particularly this year, he's having more fun than he's had since the 1970s, in the sense that it's fun for him to be able to be buying things at screaming cheap prices. So I would bet a fair amount of money that he is, I'd say odds are better than 50-50 that he is still CEO of Berkshire Hathaway for 10 more years. If you look at actuarial tables and his family history and all, it's probably a pretty good bet. But our most important piece of this is we assume no Buffett premium today. Other questions? Yeah?
Yeah, so I apologize, I haven't read a lot of your articles, but it seems you are writing a lot. How do you manage to protect your own investment theses and also avoid conflicts of interest with your writing on the stock example you gave?
Yeah, well, I guess there are a couple different ways to think about that. There are multiple issues. I mean, one are sort of legal and compliance issues, and the answer there is full disclosure, and we just don't trade stocks that we're going to write about in the period immediately before and after we publish an article. And that's true of Value Investor Insight, the newsletter we publish monthly. That's true of the Value Investing Congress, the conference that we do twice a year. Then there's the sort of mental and psychological piece of it that I talked about before, where you have to be careful not to fall into these commitment traps and so forth. Part of the reason we do this is I do all the public speaking. My partner does none of it. So we sort of try and separate out. I might get some commitment bias, but hopefully he doesn't get too much of it. Is one serious way that we, I'm sort of joking, but sort of serious about that. And look, I guess that then there's a question, if you're an investor with us, you might ask, well, gee, why are you sharing? Our only asset is our intellectual property. As an investor, that's all you got is your stock ideas, right? So why do you share them? And the answer is we don't share them if it's anything illiquid that we're still trying to buy. For example, we're very careful. We try certainly never to write about anything that we would even think of selling. The Leucadia case is extremely unusual. where we would write about something and then, relatively soon thereafter sell it because new information comes in. But that's okay. There's always a disclaimer that positions may change, et cetera. Just because not only do we write, I'm on TV almost weekly these days on CNBC or Bloomberg or whatever, similar kind of dynamics. Talking about stocks that we like. What we find is that any possible downside to talking about it, and there is possible downside, like what happens if we talk about a stock that we think we're finished buying, and then new information comes in, we decide we want to make it a larger position, and the fact that we talked about it means that the stock price had run up, for example. There is potential downside there. We only run about $100 million, so we're generally not moving stocks, dramatically. And I'm not, it's not like I'm Warren Buffett or something where if somebody knows I'm buying something, the stock surges on that news. So that also mitigates it. The upside to us of talking about it, in addition to fueling my ego, is that when people know we own something, like that Leucadia call. Okay, we got a phone call from a friend of ours who, it turns out, had done some basically, honestly, embarrassingly, better analysis than we had done on Leucadia. He figured out that book value is probably going to be 15, not 25. Well, he wouldn't have called us up. He wouldn't have known to call us if he hadn't read my article where I said we own Leucadia. We traffic in ideas, stock ideas and information about stocks we own, but also new investment ideas. So we share with other people our investment ideas, and hey, there's reciprocity out there. People share back with us their investment ideas. So a lot of our best investment ideas are, some smart person that we know says, hey, I just bought a big stake in this company. You might want to take a look. We find that there's more upside than downside to us, but there's certainly some of both. Sure.
You mentioned talk to management, as you always do, but I feel like it's easier to get $1 million versus thousands. So what's a good proxy for someone who's just...
Yeah, you guys will encounter to a more extreme degree what we encounter in that we're sort of rinky-dink in the scheme of money management. So, Bill Gates isn't taking our call if we're thinking about buying Microsoft. Because we manage $100 million, and if you're just managing your own portfolio. So the answer is we're more likely to make a call to a smaller cap company where we have great access, because even with $100 million, we're among the largest shareholders of a half dozen companies that we own, and that does get management's attention, certainly. But honestly, we go back and forth on how valuable is it? I've never talked to a CEO who didn't think his business had, in most cases his, forgive the sexism, but who didn't think his business was significantly, had wonderful future prospects and was significantly the stock was significantly undervalued. Like, that is universal. And so it can be very dangerous going in and talking to and you see, they genuinely believe it. Okay, so that makes it even more convincing. And they, of course, have much more knowledge about their company and about their industry than you do. So it's easy to believe and get drawn into situations. And again, I've seen investors just get blown up with companies going to zero, and management got blindsided. Management insiders were buying even. So it may, in some ways, be helpful to us that we're small and management won't take our calls. Every situation is different. In some cases, evaluating management and getting to know them and having conversations with them is a very important part of the investment thesis. And sometimes you can't talk to the CEO, but you can go to investing conferences where the CEO's giving a speech and then there's a Q&A. Sometimes you can dial into the conference calls, and they don't know how much money you're managing if you push *1 to ask a question on the call. And often you don't need to talk to the CEO. You can talk to somebody else. Sometimes the CFO will take a meeting. Often the investor relations people are actually pretty smart. So there are lots of other ways. Often you'll find, though, look, in Microsoft, I don't need to talk to Bill Gates. I can see that Microsoft's trading at 12 times earnings, has $5 a share of cash, and the things that will determine whether buying Microsoft today is a good investment are not things that Bill Gates knows or can tell me. Why don't I move on just in the interest of time, because what I do want to do is break at 8. Anyone who wants to leave can, and then I'll continue going on because we've got 3 more case studies to cover. So, Fairfax. Fairfax has been called the Berkshire Hathaway of the North. It's a Canadian reinsurer run by a guy named Prem Watsa, who's been called the Warren Buffett of Canada, et cetera. Not a particularly good analogy, but there are some similarities. In both cases, you have a very savvy investor who's been running the company since inception. Prem Watsa started Fairfax in 1983, has been running it ever since. In both cases, they take no salary, have never sold a share of stock, take no stock options, and they run insurance companies that also have, but also generate a lot of value from investing wisely the float that's created from insurance. So those are the similarities. The differences are is Fairfax has grown by acquiring broken down, crappy insurance companies, and that can be a very risky business. It almost took Fairfax out of business, in fact. Back here, and if this chart goes back further, back after 9/11, they took big losses. They acquired some bad insurance companies at a very steep price, but it turns out the losses were much greater than expected thanks to 9/11, thanks to Katrina and Rita. And whereas Warren Buffett doesn't buy broken down turnaround situations. Fairfax does not own a lot of operating businesses. It is purely an insurance company, whereas Berkshire Hathaway, maybe a third or a half the value is in the insurance operations, but then Buffett has very cleverly bought a lot of companies outside the insurance industry. So with that background, you can see the stock has been crazy volatile. We've owned it from about here, rode it up, rode it back down, bought a bunch more, rode it up, rode it down, and today it closed today at 296. So let's talk about Fairfax. It's got a number of different operations. Odyssey Re actually trades separately, but it's a subsidiary, but has a very similar profile. We own both Fairfax and Odyssey Re. They've got a very small piece of their operations, but rapidly growing, potentially very valuable over in Asia, particularly India. But here are their main three operating businesses. So this is a sort of a summary of this. They just released quarterly earnings last Friday, so I can give you some of the numbers. In the first 6 months of this year, they earned $34 a share. Last quarter, they earned $25 a share. So they've earned $60 a share in the first 3 quarters of this year, and the stock is at a little under 300. Book value is still about 250 this last quarter. So here are their 3 major insurance subs. If you understand the insurance industry, you'll see a low combined ratio is good. That means they're making a profit on their insurance operations, plus they get the benefit of investing their float. Nice return on equity, and you can see very nice growth. So these, if you look at these numbers, year to year and all, you'll see a much improving situation among their major insurance subsidiaries. So this is the quick takeaway on this is that this is appears to be a very good, solid insurance company. Obviously, you want to look at this. By the way, I threw this in here just straight from their earnings release. I didn't have time to make. Like I said, they just reported earnings, so I didn't have time to make a fancy slide. But here's the $25 a share they earned last quarter, and here it shows that this year, in the third quarter, their combined ratios jumped from the 90s level. Here you can see last year it was in the 90s and even 80s, and it's jumped up quite a bit in the third quarter. Here they had no super cats. Here they had Hurricanes Gustav and Ike, so they paid out a bunch of claims. So this, like Berkshire, is a lumpy business, but over a long period of time, they've written at a sub 100 combined ratio, which is sort of the gold standard. So you'll see here's a summary of what's happening to Berkshire over time. Cash and investments have gone up a lot. Debt has gone down. They've made a ton of money on their credit default swaps. I'll talk about that later. Book value has gone up dramatically. Book value per share has gone up dramatically. So over the past year or so, this company has had a dramatic improvement in its financials. So here shows that particularly when you want to look at any insurance company, you want to see real financial strength, so debt to total capital, net debt to total capital, and total debt to total capital. You can see back in 2003, this company was very financially quite weak. And in fact, this is the one of only 2 companies ever in 10 years that we at one time were short. We were short the company back here because one more hurricane, one more major claim probably would have taken them under, would have been a 0, okay? And we were short it profitably from 200 down to 100. And then we covered our short. Fortunately, the stock sort of rallied back to 200. And then many years later, we came back and we went long the stock around 200. And the reason is look what's happened to the financial strength of the company. It's improved dramatically, and even more so in the first part of this year. So you have a company, good insurance operations, albeit had a crappy third quarter thanks to a couple hurricanes, with dramatically improving balance sheet strength. So this is a summary of the credit default swaps. Now let me explain. Credit default swaps you've probably been reading a lot about in the paper. They were what took AIG under, for example. They've caused some people, it's a zero-sum game. Some people have made billions of dollars on owning credit default swaps, and the counterparties to those people have lost billions of dollars writing credit default swaps. So let me just briefly explain what they are. A credit default swap is simply an insurance policy on debt. So if you owned $100 million of GE debt, let's say you're a big pension fund or something, and you want to own insurance in case GE ever defaults on that debt, someone will sell you that insurance policy. To some extent, it's like buying hurricane insurance, right? If you're worried about your house getting blown over in a hurricane, to protect your very large investment of $200,000 house, you might pay $1,000 a year for hurricane insurance, right? In case a hurricane ever came. So all credit default swap is it's hurricane insurance on different forms of debt. A credit default, and the word swap is misleading. It's not credit default swap, it's credit default insurance. That's all it is, okay? So this market exploded recently over the past few years, and I've now heard that there's a notional value of $60 trillion of credit default swaps outstanding, which basically means if every company and every form of debt that is being insured against defaulted and went to zero, that it would be $62 trillion of coverage. Obviously, that's not going to happen. What usually happens is credit default swaps have been used, we've used them, as instruments. They're long instruments. You would buy the insurance if you think a hurricane is going to hit a particular company. And then if you're right that the hurricane hits, the cost of that insurance increases dramatically, and then you can sell the insurance, or you can wait for a default if a company actually defaults. So it's been used, most credit default swaps used to be used by people who owned the debt and simply wanted to hedge to protect their debt. Okay? If you're the homeowner in Florida, you bought some homeowners insurance. Okay? What credit default swaps have morphed into, and the reason the market has grown so much is guys like me, people who run hedge funds, see that a hurricane is coming to Florida, but the hurricane is coming and it's going to hit next month. And I know I have a high conviction because my research tells me the hurricane is coming, so I'll go buy insurance on a home in Florida, even though I don't own the home. Okay? And somebody is willing to sell me a $200,000 policy that pays off if the hurricane hits, and they're willing to sell it to me for $1,000. Okay? That's effectively what credit default swaps were. And companies like AIG wrote $427 billion of coverage, and they got paid between $1 and $2 billion. They collected $1 billion or $2 billion in premiums over the last few years. Okay? 96 billion of the 427 they were writing protection on senior tranches of CDOs. Okay, the hurricane really has hit CDOs if you've been following the markets, right? So they have had to put up, what's interesting is the CDOs haven't actually defaulted. What drove AIG into bankruptcy is their contracts with their counterparties may force them to put up cash collateral as the value of the CDS went up. So even though there wasn't a default, the contract said you have to put up, if you sold us a credit default for 20 basis points of whatever the dollar amount being insured was, and that spread is now 1,000 basis points, you have to put up 1,000 basis points worth of cash because I can sell my insurance back to you for 1,000 basis points. Okay, so AIG very suddenly had to come up with what initially was $50 billion. What today we, the taxpayers, are on the hook for approximately $100 billion on best guess. Okay, they haven't actually paid it out, but they've had to post the cash collateral. And now the big question for we, the taxpayer, and for AIG is how much of that is actually going to have to be paid out? Because basically now the hurricane, instead of being a month away, is a day away. And nobody knows exactly what the losses will be. But AIG has had to post cash collateral of, let's say, $100,000 on that $200,000 house because we're not sure how bad the damage will be to the house. Okay, that's what's happened. Now, I would argue, I'm digressing a little bit here, but I would argue that it's absolute madness for AIG, for the US government, which now controls AIG, to allow them to pay out that money. Okay, AIG basically went bankrupt, and the people who bought the insurance from AIG bought from a bad counterparty, and they should get in line with every other creditor, and I think it would be insane for the US taxpayer, US government, to pay out $80 billion to a bunch of hedge funds and pension funds and so forth that bought this insurance from a counterparty that was stupid enough to write it, but now we're all on the hook for it. That's so hopefully the new Treasury Secretary will figure this out. Right now, if you open the paper, everybody's complaining about, you know, $50 million worth of bonus payments to executives or something. They're focused on $50 million, and they're not focused on $80 billion. Okay? They're focused on completely the wrong thing. So why is this? Why am I telling you this related to Fairfax? Because Fairfax was one of those smart investors that saw the hurricane coming, and they bought billions and billions of dollars, $21 billion notional of credit default swaps on AIG, SocGen, Fannie, Freddie, XL, Goldman, MGIC, and this is only their WAMU, and PMI. If you know any of these stocks, they nailed it. They absolutely nailed it. Now, how much did they pay? They paid $435 million of upfront cash to buy insurance on $22 billion. So far, that $400 million is worth $2.5 billion, all in the past 12 months. And they've already banked. Now, this chart is now a month old. This is the chart that came out yesterday. So $21 billion, they paid $433 for it. They have now banked $2.6 billion, of which $2.05 billion has already been cashed out. They already sold it and banked the cash. So one of the things you want to worry about is when you write the CDS, if their counterparty is AIG really going to pay them? There's real counterparty risk when you buy these things. Well, there's no counterparty risk on $2 billion of cash. The only counterparty risk left is $600 million, which is the amount today. Right now, Fairfax owns a notional amount of CDSs of $10 billion. They paid $191 for it, and it's currently valued at $600 million as of October 24th. Okay, so they've currently booked $400 million in profit on their current portfolio of CDSs, but they already booked $2.2 billion. No, they already booked cash $1.8 billion of profit, selling something they bought for $240 for over $2 billion. And so you can see the numbers. This has been one of the most spectacular investments I've ever seen a company make. A hedge fund would be proud. So this is Prem Watsa's long-term investment track record, both in stocks and bonds, and you'll see one heck of a stock and bond picker. And here's sort of a summary of, since 1985, I think the company was founded in 83, but it lost money the first couple years, so to do a comparison, they started in 85, and you can see that under current management, this track record rivals Berkshire Hathaway's. I mean, look at this, book value up 166x, stock price up 100x. You know, this has been a spectacular long-term company. So today, with the stock, yesterday closed at 283. Today, one of the nice things about Fairfax is today the market was down big, but that helps Fairfax's CDS portfolio when there's chaos in the market. So Fairfax is actually a fairly good, it often trades inverse to the market. So if you don't want to go out and short stocks, but you want something to protect you against a meltdown, a continued meltdown of the financial sector, Fairfax is a good way to play it on the long side. So the stock was up a few percent today. Stock is at about 300, but based on yesterday's closing price, the company has about a $5 billion market cap. They have almost a $5 billion book value based on last Friday's third quarter earnings release. So it's trading a little over 1 times book. Even if you value the entire CDS portfolio and say, you know what, that $600 million could go to zero, and it could if the panic in the market ends, no more financial companies go under, those credit spreads that were at 20 basis points that went to 2,000 could come right back in. So even if you want to back out the CDS portfolio and assume that they take 100% loss on it, but you know, tax adjust it, company's still trading at 1.2 times book for the core insurance business. Now, a good insurance business like Fairfax will typically trade at 1.3 to 1.5 times book. So I'd argue that you're buying, if you want to use this analysis, you are buying a good, nicely growing, well-managed insurance business at a moderate discount to intrinsic value, and you're getting a CDS portfolio for free. which is a nice thing in this environment. So that's Fairfax. Any questions?
You talked about how the government shouldn't bail out AIG. You think the same about you think they should bail out Lehman instead? Yeah, no, that.
No, I think the government should have bailed out AIG. I simply think in processing the claims that they should not pay the claims or should pay pennies on the dollar on the CDS losses that AIG took. In other words, when a company goes bankrupt, it goes into runoff and all the creditors get in line. If it's an insurance company, you have the debt holders. You have the equity holders most junior, then you have the debt holders, and then you have the policy holders in superior order, right? The policy holders come first. And then what happens when an insurance company goes into runoff is you calculate all the losses and the claims, then you look at your assets, and then everybody gets paid off some percentage on the dollar. My only point is it would be absolute madness to pay off these CDS claims at 100 cents on the dollar, leaving either no money left within AIG to pay other claims. It's one of the largest insurance companies in the world. They're going to have lots of other claims from policies that they've written. I think I'm not saying I think that the government should have backstopped AIG. I simply think that the government should not inject endless capital to make every claim holder within AIG whole, that the debt holders should take a hit, the policy holders, particularly the CDS holders, should take a hit as well. The real question is how big a hit can you stick them with without blowing up our financial system? And the problem is nobody knows the answer to that question. So in terms of Lehman, I'm somewhat conflicted on Lehman, not conflicted legally, but conflicted in that I'm not sure I know whether it was the right thing to do to let it go under. Probably the government should have engineered something. Had the government come in and backstop probably $20 billion, Barclays would have bought Lehman, B of A might have bought Lehman, but then B of A wouldn't have been available to buy Merrill, and Merrill might have gone under. Merrill was on the verge of going under, so you might have just shuffled the problems around. But the unwinding of Lehman actually going bankrupt has clearly was a major trigger to the complete roiling of the worldwide financial system. The only sort of argument for letting Lehman go under is that, for example, in the case of Bear Stearns, this was we experienced the world's greatest bubble in history, but it wasn't an equity bubble, it was a debt bubble. Okay, every form of debt, from U.S. mortgages to leveraged loans to credit cards, to you name it, it was the world's greatest debt bubble. But the problem is like when Bear Stearns went under, the debt holders should have taken a beating, and they didn't. Okay, Bear debt holders, when it got acquired by J.P. Morgan, got back 100 cents on the dollar as the equity holders that got killed. So you have a real moral hazard issue here when in the midst of this collapse, you've got all the equity holders who weren't speculators. The people who bought Bear Stearns at $70 or $80 a share were buying it at a discount to book value. They weren't speculating. This wasn't some crazy internet bubble, right? I mean, they just didn't foresee an unprecedented train wreck. But the point is from a moral hazard perspective, it's very dangerous to do a bailout where the people who are sort of least culpable, the equity holders, get massacred, and the people who are most culpable, the debt holders, get made whole again and again and again. I think, though, there was probably some way to engineer saving Lehman from bankruptcy, but also whacking your debt holders to an appropriate degree. And so, I'd like to think there was some way to do that, because certainly what we sort of know now, what we got was a disaster. So almost anything would have been better than what we got. Other questions? Yeah?
On the CS portfolio, how do they manage their counterparty risk? And also, are they writing these policies?
I'm sorry, do they what?
Have they written actually the CS policies as an insurance?
Oh, no, they only buy them. They only buy them. Yeah. The answer, the way they manage counterparty risk is a couple ways. First of all, you can look, if you're clever, you can find filings, not for Fairfax, but for Odyssey Re. They own the same CDSs, and you can just determine that the counterparties, almost the entire counterparty risk was Barclays and Citigroup, which are pretty good counterparties. Turns out they nailed the two institutions that, at least so far, haven't gone under yet. That's why they've been able to collect over $2 billion of cash. The other thing is because they're very large purchasers of CDSs, and why you don't want to go out and buy CDSs on your own is because CDSs, there's not a liquid market. It's not like buying a put or a stock or something where there's some liquid market. A CDS is a negotiated contract with one counterparty. It's called an ISDA agreement, and every ISDA agreement's different depending on what your negotiating leverage is. Because Fairfax was a huge, huge buyer, they bought $400 million of these CDSs. They were able to negotiate ISDA agreements that requires their counterparties every day, based on what the market price of the spread of the CDSs, to post cash collateral every single day. So as the spreads blew out on all of these things, the cash was sitting there right there for them to collect anytime they wanted. So they've managed the counterparty risk about as well as you could. Okay, let me walk you through one more case. I think that will bring us to 8 o'clock, a couple minutes after 8, and I will leave the entire MBIA case study, which has been probably our most profitable short investment ever. We were shorting more today. And we shorted this 5 years ago. We've been shorting this thing as it's gone from 35 to 70 to today's level of 8. And I can walk you through MBIA. So there's your little teaser to come back after we do a little bathroom break at 8. Because it's an absolutely fascinating company, and you can learn a lot about what's wrong with the whole worldwide financial system by looking at what happened to MBIA, because it's a story that's been repeated over and over again. So let's talk about Target. And just so you don't think I only talk about stocks we do well on, this one, as I mentioned earlier, we've lost a lot of money on. We were buying it back in here in the 60s, and we probably bought some more here, and we felt pretty smart here, and then boom, in 4 weeks, thing got cut in half, almost half. And this is what this is called. Partly, this is two things happening right there. One is the fundamentals of the economy. This is when Lehman blew up, credit crunch, in turn is affecting consumer spending dramatically. So the future outlook for all consumer spending, go look at the stock chart of any retailer, any U.S. retailer, and it looks just like that over that period. Regrettably, we own many of them. But the other piece of this is that's hedge funds liquidating. This is a stock that, because Bill Ackman, well-known hedge fund guy at Pershing Square, is one of the lead activists. A lot of guys like us were in the stock, partly because of him being in it and his plan to do something to unlock value. So hedge funds suffered their worst months ever in September and October. Enormous redemptions, deleveraging. This is what happens. You get things like that when you get a margin call from your prime broker, and your prime broker seizes your entire portfolio and dumps it immediately onto the market at any price. So this forced selling seems to have mitigated somewhat. The stock quickly popped back. We bought quite a bit down here. So we still like this situation. So what do we like about it? It's a really good company. It's got a very long-term track record of very nice growth. This shows all sorts of measures of that. This is just from their annual report. This shows the penetration of Target in different parts of the country, but the long and the short of this is that there's still lots and lots of room for Target to grow. Target is something like 1/6 the size of Walmart. To give you a sense of, this is a company that could easily double its number of stores just in the United States without saturating its markets. And we think they have a very nice niche, sort of a cheap chic, a little more upscale than Walmart, but still at very competitive prices, et cetera. So this is again from their annual report, the last 6 years of financials, and just in the interest of time, you can find their annual report on their own. But you'll see a very nicely growing company with very nice margins, strong balance sheet, et cetera, et cetera. What's not to like? So this is the report just from a couple weeks ago on their same-store sales for September. Obviously one of the things, September was when the U.S. consumer really started to tip over. Target is holding up better than almost all other retailers. Total sales were up 2.5%. But more importantly, because they're opening new stores, same-store sales were -3% during the month. That's not great, but consider that a lot of retailers, had negative comps of 10 or 15 or 20% because consumers stopped spending. Target is selling underwear and the same kinds of things Walmart is selling. So this is, if you're going to own any retailer in this environment, a retailer with a very strong balance sheet that people who might have been shopping at Macy's and so forth might trade down to, and so they might be losing some spending from consumers who can't afford to buy anything these days. There might be other consumers downsizing, downshifting to Target, and so we think Target is pretty well positioned to weather the storm that is no doubt upon us. And their, at least early indications are that they're weathering it okay. So here are the earnings estimates that have recently obviously been taken down in light of the economic environment, but they're projected to earn the latest consensus estimates, which the company recently reaffirmed. We're now 3 quarters into the year, so they have pretty good visibility as to what the 4 quarters are going to look like. Earnings look to be about $3.30. Stock today was down 8.7% to $37, so it's trading at 11.6 times this year's earnings estimates. This is a company that, again, historically has traded at 20 times, and so we think it's just sort of cheap on its merit. What's interesting about it is that there's also a potential catalyst here, led by this is some slides from Bill Ackman's presentation. He runs a $6 or $7 billion hedge fund called Pershing Square, old friend of mine from college days, and so he went public a week ago, and actually if you want to see the entire presentation and the video of him presenting it, it's posted on one of my websites, valueinvestingcongress.com. Over on the right-hand side, you'll see a little thing that says link to Pershing Square presentation on Target. And so I've just pulled out a few of the slides to just give you a flavor for this. Right now, Target is trading at about 6 times EBITDA, enterprise value to EBITDA, which is one way to look at it, at about $40 a share. Today, the stock's at $37.75 or so, so it's a little under 6 times EBITDA. And here are what some REITs trade for. Multiples of EBITDA, and you'll see Bill's idea is to spin off Target's real estate holdings into a REIT. So the idea here is that Target owns a lot of real estate, and then they operate a retailer. And his belief is that if you separate those two into 2 stocks, there will be 2 benefits. One is as a REIT, because it has to pay out all of its earnings, has a very tax-advantaged structure, so there's not taxation. All the earnings just to the REIT go straight through, saving over $500 million a year of taxes. That's real cash savings. The second value creation from spinning this off is that, as you can see here, REITs trade at much higher multiples than retailers do in today's environment. So the combination, so here is a summary of Target's retail operations and a target of their real estate operations. And you can see Target owns 95% of its buildings, 85% of the land under its retail locations. It's actually it owns more of its real estate than any retailer in the country, and it owns really good real estate. And so the argument is that the REIT would be a premium REIT that might even trade at a premium valuation. So this shows how much of their real estate that they own relative to other retailers. And this shows sort of the math. If you were to split this up, and it shows, here's your $500 million in taxes. See, right now they're paying $1.5 billion. If they split into 2, the retailer will pay $1 billion, but the REIT pays nothing because of its REIT structure. So there's your $500 million in savings. So it immediately bumps your earnings up substantially from $340 to $402, mainly on the tax savings. And then if you put a multiple on the remaining retailer, assuming today's depressed multiple, but then you put a higher multiple combined with, we got to add the tax savings here, then you put a higher multiple on the REIT earnings, you take a $40 stock, 37 and change today, up to a $70 stock immediately, and then with some additional cost cutting and other benefits, that stock is probably worth $83 is what he calculates. So that's the very quick overview of Target. If you have the stomach for what will surely be a volatile ride and very crappy news for consumer spending, for at least the next year. Questions? Yeah.
Earlier you mentioned we have a couple of hedges placed play.
Yes.
Exclusively mall REITs. What is your outlook on mall REITs? And why did you pick Simon Property Group to indicate for that small stuff?
Yeah, we picked General Growth, which has been beautiful. If you've followed that, GGP is down 95%, probably going to 0. Macerich, Simon Property Group and Boston Properties are 4 mall REITs. They were trading at an average of 15 times EBITDA or something like that, which is these numbers right here. And we said, you know what, malls in America, given what we're trying to hedge against is a real decline in consumer spending, it is absolutely impossible that mall REITs can maintain that kind of multiple. And so we were actually quite happy to short them on their own. We thought they were good shorts as standalone shorts, and even better given that we owned 2 companies, both Target and Sears, both of which a big portion of the value that we were calculating was based on their real estate. It was a great hedge as well. That's always a great win-win when you get a great short on its own and it's a good hedge, mitigating a risk factor of something you like on the long side. So why Simon Property? No particular reason. We shorted a basket that we're all trading at a high multiple and that we thought would have exposure if the U.S. consumer collapsed. Yeah.
I'm curious where your outlook is on the hedge fund redemption scenario. I've seen that come play with a lot of good names recently. I'm wondering, is the worst of that over in your opinion, or if not, how many more months of redemption are we really looking at here?
I wish I knew. There will be substantial redemptions. There's no question about that. The question is does the money get pulled out of the industry entirely, or does it just get shifted into the better performing hedge funds? But the investors maintain confidence in the asset class. I tend to think more of the latter. Some of the money will be pulled out just because the fund of funds and others are delevering, and they're reducing exposure to all asset classes, not just hedge funds. But I tend to think, look, hedge funds are taking a beating this year, but they're down roughly half of what the market is down this year. So to some extent, hedge funds are supposed to deliver positive returns in any environment. But you know what, given hedge funds still may be among the best performing asset classes of anything that an institution owns. Given that their private equity investments have gotten obliterated this year, and so many other things. Any bonds except treasuries have gotten obliterated. So it may well be that I don't think this year is the death knell of hedge funds in general. It is certainly, to quote Warren Buffett, he says you can't tell who's swimming naked till the tide goes out. Well, the tide went out, and it's been very clear now. The whole lot of people have been swimming naked. And those people are going to suffer big redemptions and go out of business in all likelihood. But a lot of people prepared for a storm, built an ark, and are doing okay. We're in that group, fortunately. We're down a few percent this year, single digits, so our investors actually think we're sort of heroes, which is nice. We're actually raising money. We've raised incremental capital from our investors. So, but in terms of when the selling will end, hard to know. The nice thing about hedge funds, sell for 2 reasons. One is in an orderly fashion because they get 45 days notice and can unwind slowly. But a whole lot of hedge funds are blowing through margin calls. Their prime broker seizes their assets and blows it out in a day or 2. And so at least there, the selling pressure is quick. It tends to dissipate pretty slowly. So I think, my guess would be is the real question is there's going to be redemptions and selling pressure, because keep in mind, even the guys swimming naked, who are down a lot this year, have lockups, and unless they're shutting down, those lockups are still in force, and so those lockups will spread out the redemptions and therefore spread out the selling, generally over the course of the next 12 months probably. So to that extent, there will be selling pressure for some time. Offsetting that, though, is there's a whole lot of cash and buying power in the world, so it's really just a question of when the bargain hunters come out to offset what will likely be selling pressure for quite some time. Did I see a question in the back?
Let's take one more question and then we'll...
Okay, and then we'll take a 5-minute break, and anyone who wants to hear about MBIA is welcome to come back.
Looking at Target as splitting into a REIT, my limited knowledge, aren't most of the properties surrounding Target already developed? And where do you see the growth from Target?
Yeah, the growth in, it's a good question. The growth from Target REIT is not that the REIT will own land under the Target and then acquire adjacent parcels and start leasing adjacent parcels to other stores, non-competitive to Target presumably, et cetera. That's not the growth. The growth is that Target continues to open, they've scaled back their growth plans a little bit, but still continues to grow their square footage by, roughly 6% a year for the foreseeable future, at least 5 years or more. And so the target REIT for the first 2 years under the Pershing Square proposal will have the exclusive right. Target will have to, every new store that they open, they're buying a piece of land is the first step of the process. They will have to have the target REIT buy that land. So the target REIT is able to grow, whereas most of the mall REITs now, the other large REITs are looking at shrinking, unclear where their growth is going to come from because many of their tenants are going bankrupt, et cetera, et cetera. This REIT actually, while it has the risk of being a single tenant REIT, it also has the advantage of having one of the premier tenants in the world and one that's got a lot of growth ahead of it. So the growth will simply come from new store openings. So with that, anyone who wants to use the facilities, wants to leave, you got homework, whatever, please feel free. Otherwise, stick around and I'll spend some time going through MBIA.